We live in challenging, stressful times with a barrage of mixed messages about what's ahead for our economy and our property markets. Everything seems to be stacked against those looking to invest in property. Falling values, rising interest rates, and various governments interfering, making it seem like we're losing control of our investments. The bottom line is investing is getting harder. It's easy to see all the risks and all the problems that are happening in the world at the moment, but in 5 years' time from now, it's likely we're going to look back and see lots of missed opportunities because the rear vision mirror is always clearer than the windscreen. Now, another prediction I'd like to make is that in 5 years' time, about 50% of those who buy an investment property in the next year or two are going to have sold up. Now, why do I say that? Because that's what's been happening for the last few decades. And unfortunately, for many who will keep holding on to their investments, they won't be owning an investment-grade property, meaning they won't achieve the financial independence that they're looking for. So what can you do about this? How can you end up being in that small group of investors who owns a substantial property portfolio? That's what I'm going to be asking leading financial advisor Stuart Wemyss in today's show. So welcome to the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Currently, less than 1% of all property investors own 6 or more properties. Now, there's nothing new about this, and as I said in the introduction, most property investors are going to fail to achieve their long-term financial goals. However, I believe if you plan, and if you follow a proven formula, and if you avoid the common mistakes, there's no reason why you can't also fall into that top 1% of investors. Now, recently, leading independent financial advisor Stuart Wemyss, founder of Pro Solution Private Clients, wrote a number of very insightful blogs that should help you down this path, and I'd like to unpack them in today's show. So, hi Stuart.
Hey Michael, really looking forward to our conversation today.
Well, Stuart, one of the points that always seems to come up when people are trying to put a plan together, and I know that you help your clients by putting a plan together before they start investing, is the argument of cash flow versus capital growth. It's been around for as long as I've been investing and you've been investing. Now, I recognise that most people who want to get in property investment eventually want to replace their personal exertion income with this. They want to have more choices in life with cash flow. But chasing positive cash flow too early in the piece, is that a way of achieving the financial goals they're looking for?
I think with respect to selecting an investment property, the right investment property, focusing on the income will probably invite you to make a mistake. And look, I can see logically, how people sit back, investors sit back, and particularly I think, first time or newer investors, because more seasoned investors will have probably from their mistakes. But, they probably sit back and think, okay, I'm going to go invest in property. And so they make the decision to do that. And then I guess it's natural to then think about how do I lessen the cash flow impact of doing that, not understanding that there's an implication associated with doing that. Because obviously, if we go and invest in property and we borrow the full cost of the acquisition, obviously the net rental income, so rental less expenses, will be less than the interest repayments. So there is a negative cash flow cost that we need to supplement from our other income.
Now, sorry to interrupt you, Stuart, but I think this is a fundamental that many beginners don't understand. Residential real estate is basically a high growth, relatively low yield investment. And if you try to make it something different to that, you're really bastardizing the asset class that it is, aren't you?
Yeah, bang on. And the reason for that is that if you want more income from a property, you need to spend more on the dwelling, the building value. And we all know buildings over time depreciate, whereas it's the underlying land value that appreciates. So in order for me to target a residential investment property that's going to generate more income or higher income levels, I then need to spend proportionately more on that building value. Mm-hmm. So there's no such thing as a free lunch. What I might gain in terms of income, I will lose in terms of capital growth just because of the land value proportion of a particular asset. And that's the mistake. The mistake is not really appreciating the power of compounding capital growth. And that will generate a hell of a lot more wealth over the long run than an incremental increase in income.
Now, clearly, cash flow is important. You need cash flow to get you in the game. And I know your team, when you put your plans together, also help clients with mortgages. And you don't just buy them property, we buy them time by getting financial buffers in place. So there are ways of seeing yourself through those cash flow shortages if you set up your structures, finance structures right at the beginning, aren't there?
That's right. But even more so than that, understand the opportunity cost.
Yes.
So you might think, okay, well, this property is going to cost me $200 a week, whereas the property down the street, which is actually a much better quality asset, is going to cost me $300. And you might look at that and say, well, I'll go for the $200 one because I'm saving $100 a week. But what you're actually probably doing is foregoing maybe $1 or $2 million in 30 years' time in today's dollars. So the opportunity cost is significant. And therefore, you've got to then think about, well, I want the $300 a week property. How do I go about doing that? You know, do I need to change my budget? Do I need to change my financing structure? Do I need to get a little bit better at managing cash flow? Or maybe all three of those things. But whatever it is, don't compromise because it's going to cost you a couple of $1 million in the long run.
Now, that's a huge number you're saying, but you actually haven't pulled that out of your head. You've actually done numbers and figures. So in the show notes, I'm going to leave a link to your blog on Pro Solution Private Clients website, which shows the charts and the numbers where this information's come from. That way people can actually see the real cost. They're thinking short-term rather than long-term, aren't they?
Yeah, that's right. And just to sort of summarize, it's my hypothesis that, you know, in the long run, over a few decades period of holding a property, it's probably unlikely that your total return is going to exceed 10%. And in fact, if you have a look at over the last 3-4 decades in most capital cities, that broadly the total return's been about 10%.
By total, you're talking about cash flow and capital growth. Is that right?
Rental income plus capital growth, correct.
Yeah.
What is different, though, in those capital cities is the proportion of income versus capital growth. So if you look at Perth tends to be higher income, lower growth.
Yep.
Sydney tends to be very low income, very high growth. But the point is that over the long run, it's probably unrealistic to expect more than 10%. I mean, hope for it, but probably unrealistic. So therefore, as investors, we can then decide what location and then type of property, which will then inform us around how the return is made up. You know, do I want more growth or more income? And I can manipulate that by where I'm investing and the type of property I'm investing.
I guess that makes a difference what stage of your investment cycle you're in as well. So beginners need to build an asset base. It's got to be done in the right order. Build your assets first, and then you can eventually turn to cash flow.
Yeah, spot on. So what I did, Michael, is compared two properties, one that gave me a 4% rental yield, that's gross, that's before expenses, plus 6% growth, so 10% total, versus 2% rental yield and 8% growth. So again, total 10%. And really, if you have a look at the statistics, longer term sort of median house price growth, etc., we're probably talking about, say, Perth versus Sydney in those sort of numbers. And so what I did is I added up and said, we hold this property for 30 years. I added up all the cash flow costs, the tax benefits, the maintenance you have to pay, land tax, all the stuff, and then suggested, okay, well, if we sell it in 30 years' time and put all the money in the bank, so we've got to pay capital gains tax and so forth. So I've done all the numbers, and then I discounted it back into today's dollars to make it more meaningful. So we're talking about today's dollars. And over that 30-year period, the difference between those two assets was just over $1 million in today's dollars. So here it shows that we think seemingly, we bought a good property, it's a 4% yield, it's not bad, it's not going to cost me too much out of pocket each week, month, or however long we look at it. But really what we've done is just made $1 million mistake.
That's a huge error, isn't it? And that's why planning and putting numbers and figures into your plan as opposed to gut feel is so important. Now, one of the other points you made in your blog is that while many investors mistakenly focus on income, a lot of buyer's agents are doing the same, Stuart.
The problem I think buyer's agents have, so someone that's completely independent of buyer's agents, of course. Now, you might hear buyer's agents talk about other buyer's agents, but there can be some vested interest there, of course. I'm not suggesting there is, but there can be conflicts. As a kind of independent arbiter or someone that's observed buyer's agents acting in the market over the last 20 years, I think that there is a commercial incentive to find the assets that suit the type of inquiries that you're getting, the type of clients that are coming to you.
Yep.
So if you're getting a whole bunch of clients that can only afford $200 a week in terms of negative cash flow, then you've got to find those properties that are going to suit that client, because there's no point presenting an investment that's going to cost them $400 a week in terms of cash flow because they can't afford it. They'll just say no, no deal, right? So I think because there's a lot of people out there that are interested in investing in property, I think a lot of buyer's agents have, I guess, changed their methodology or approach to suit the inquiry level rather than understanding firmly what makes a good investment property and then finding the clients that are going to suit that investment methodology. So quite often I find that buyer's agents will put quite a bit of weight on income to the detriment, I think, of selecting the wrong asset. And in the long run, it costs the client money, even though the buyer's agent gets a transaction away and they get paid, which is fine. I'm not suggesting they're doing anything.
Look, many of them are trying to do the right thing, but they're enthusiastic amateurs and haven't been around the block often enough to understand the implications of this.
Yeah, that's right. So I think, but be careful for people out there that are speaking to buyer's agents that are trying to educate them to focus on income. Really what a good buyer's agent should do, in my view, is say, okay, what is your budget? Okay, this is the best type of property in terms of generating the biggest return, both income and capital growth, considering both of those factors. This is the type of asset your budget suits and the location.
Well, buying the wrong sort of property is a huge mistake. As you said, it can be a very, very expensive mistake. And we all pay a learning fee. Look, sometimes we pay to the market, as you've just explained, and that's an expensive one. But hopefully our advisors will prevent us making those mistakes because they've been around the block a few times and paying them a fee is cheaper than the mistakes. Stuart, I know you recently wrote a blog on some of the common mistakes you see investors make. Now, we talk a lot about mistakes on this, but there's a reason behind it, because why not learn from what others have done and avoid it? So maybe you could go through a couple of the other common mistakes you see investors make.
One that's, I guess, cropped up more so over the last 5 years than the previous 15 is using a buyer's agent that buys property outside of their domicile geographical location.
Yeah.
So that is, if I'm in Sydney, I find a good buyer's agent in Sydney and they go buy me a property in Perth, for example. I just wouldn't, personally, I would never engage a buyer's agent unless they were an expert in their geographical location. And I would want... That's what you're paying for, and I'd want many years of experience, because ultimately that's what I'm paying for, is their experience. Now, we can all do, if we have the time and knowledge, we can all do the due diligence on a particular asset, sitting in our computers. We don't have to be on the ground there, which is, I'm not saying you should buy a property sight unseen, but, in terms of looking at past growth or land size, all the sort of objective elements, we can do that. And that's good if we can outsource it to a buyer's agent to do that on our behalf. But that's not really, to my mind, where the value is. The value is that they've been on the ground in a particular location. They've seen it all. They've seen it through good markets, through bad markets. They witness that this pocket just doesn't really work. For whatever reason, it just doesn't ever kind of resonate in terms of with owner-occupiers or investors. And so we should just steer clear of that. Or this street is... there's too high a tenant turnover, so that's not good for investors. That's that sort of local area knowledge that you can't replicate easily overnight.
You can't pay for that either. Or you actually have to, I guess you can rent it. But that brings back the discussion we've had in the past too, that smart property investment is part art and part science. And you actually need both bits working hand in hand, don't you?
Yeah, spot on. And to be too analytical, you risk making a mistake. And to not be analytical at all and be all the art, that can be a mistake as well. You really need a healthy combination of both of them. And if you're going to go on, well, I would say that if you're investing a large amount in a property asset, you should always get advice when doing that. And if you're going to do it, make sure you engage someone that's going to be a local area expert.
Now, that's interesting because some people believe their experts are all around Australia and they've all got their own biases, as you said a little while ago. I know there's one who suggests that they've never bought a property worth more than $500,000 and they're aiming at a particular market. But if that's the case, they've actually missed out on, I guess, almost every capital city. So they've got their own already internal cognitive biases there that while I'm sure they believe they're doing the right thing, their clients are missing out on huge parts of the market, the ones that have performed well and are likely to continue to do so.
Yeah, I think doing your research and having an idea of what type of investment property asset you're after before you hire a buyer's agent, at least notionally in your own mind. I mean, the buyer's agent can hopefully educate you with respect to that, but having a good idea of what that looks like before you engage a buyer's agent will help you avoid some of those mistakes, I guess.
Sure. Okay, so choosing a buyer's agent who actually don't work in their patch that they know, but fly in, fly out, or just do research on the computer is one mistake. What are some of the other mistakes that you're seeing people make?
So another common one, again, recently, I guess, it's small-scale developments are kind of well publicised and people talk about them. Everyone talks about their winners, of course, never their losers. But we've had a few clients or come across a few people that have been excited about getting into doing some small-scale development. So that is, go and buy a house, bulldozer, build 2 or 3 townhouses on the same block and then subdivide. So that's what I'm talking about. And they've either been sold a property, so they might go to a particular buyer's agent or someone that's sourcing these sorts of properties. And two mistakes have occurred. Either they've bought something and haven't done a good enough feasibility study, so there's not enough profit in it to develop it, or they've bought it and they can't fund the actual construction. So if you can't actually get the money to develop it, then kind of it's a bit pointless. So I know your team's an expert in that area, Michael, so I'm sure you can probably share some experiences in that regard as well.
Well, we've been doing this. I started my development life in the 80s, and I did some really brave things. I was in my 30s, early 40s, and if I made those same mistakes today that I made then, I would have gone bankrupt. I was carried by a boom. And a year or two ago, lots of people were so confident in their property markets when we had that once-in-a-generation boom that I've seen people make the same mistakes as you have and being led astray by probably, again, well-meaning buyer's agents who haven't had the experience. We're currently involved in close to 80 medium-density developments for clients. Bryce, my son, Bryce Yardney, who's been running the development division for a long time, has done a number himself and has now, over the years, been involved in hundreds of them. So it all starts with financial feasibility. But you know what it's like, Stuart? You can make a feasibility study say almost anything. You can fiddle with the figures, so you've got to be realistic. And the thing is that if you're starting off, you're going to learn much of what you're going to learn in the first 2 or 3 developments. You're going to make most of the mistakes. And if you haven't got the deep enough pockets, you're not going to get through those. So get the right people on your side. And in today's interesting market, don't count on inflation doing all the heavy lifting or the market rising doing all the heavy lifting, because I can see real benefit in the value add process, but don't think that life's going to be easy. It's much harder than it sounds.
Yeah, which is why you want a decent profit margin to not only compensate you for the risk that you're taking, but provide for changes in markets, a change in costing, these sorts of things. And like you say, you can do a feasibility study and not provide for any of those things, and so it looks good. But really, when you add what risk am I taking? Because obviously there's 2 elements to an investment: reward, which is return, and risk. And you need to have enough reward for the risk that you're taking, and so that's really important.
I think the other thing is, what are you hoping to get out of the development? So a lot of people we see want to become a developer because it's sexy, it's trendy, it sounds exciting. It's really, really hard to become a developer and have a third party like Metropole help or project managers help you because they take a fee, and then there's the costs of selling, costs of holding, the tax you pay. To my mind, property development is a great way of building your asset base at wholesale and buying the worst house in the best streets, an old strategy a lot of people have used over time. But finance is even more important in development than it is in a buy and hold investment. And it's not as easy, and the banks are a little bit cautious at the moment, understandably. Interestingly, Stuart, they're also really cautious now if you're getting a building contract. Is the builder even going to be able to complete the job? So they're doing due diligence not just on the project, but on the developer's track record and the builder's track record.
Yeah, and they've recently learned that they just don't like cost plus anymore.
Oh, no.
Like, forget about it. They want fixed price contracts. So, I mean, there's a lot of risks in there, and which is fine. You know, there's no such thing as a free lunch, and anything that's rewarding is typically has its challenges. So we can't expect a free lunch, but just make sure you're well informed, I think.
Sure. So we're not saying don't get involved, but A, educate yourself, and B, get a good team around you. So there are a couple of the mistakes. What other mistakes are you seeing people make so that our listeners can try and avoid them?
Yeah. So the third one is focusing too much on income, which we've already spoken about. So that's really about, try and spend all your money on land. And then after the fact, so after you've purchased it, if you want to make improvements, do a development, renovation, that's the time to spend money on the dwelling. At least then you're going to get the depreciation deduction for doing that. So third was focus too much on income. Number 4 mistake was buy a new build property. So whether that's off the plan or something that's being built recently, and that's just because you're spending most of your money on the building value and substantially less on land, but also you're probably buying in an area where land supply is probably infinite rather than finite. Typically, a new build property is going to be perhaps in a new sort of land release area, or at least pretty close to it. And that negates some of the scarcity that you really need to enjoy land appreciation. And I should say, jump in here, because sometimes people go, well, I bought this block, the first stage of the land release, I paid 60 grand for it. And now with it selling stage 3 at 240 grand, there's a bit of an uplift there. Which is true. Sometimes you find those situations where the blocks do rise in price, particularly from stage 1, stage 2, stage 3, but they're one-off improvements. That's not going to happen constantly, which is great. I mean, maybe if you go and buy it and sell it next year, that's fine, but you got to pay for all the costs and capital gains tax and whatever. It's really about playing that longer game.
The thing that attracts some buyers is the marketers say, look at all the growth. But in fact, physical growth, a lot of new development is the enemy of capital growth, Stuart.
Yeah, that's right. And also as an area gentrifies, you can start seeing a bit of growth. So it'll get a supermarket, it'll get a doctor's surgery, a dental surgery, all those sorts of a kindergarten or whatever, daycare. Those sorts of amenity will then also add to the capital growth, but then it will stagnate. Then there won't be enough fundamentals to keep pushing prices higher in that particular location. And as a result, you end up with a dud investment.
Well, in general, that's because of the demographics of the people there. Lots of young families who are probably overstretching themselves to get into the home buyer market, tenants who are renting out there because they can't afford to rent elsewhere. And moving forward, as we move through the next stages of the cycle, I see much more fragmented markets where, and it's not a judge of people, but the poorer people, the lower socioeconomic groups, are going to be hit harder by higher inflation, higher rent, higher cost of living, higher mortgage costs, wages not going up as much, while in the more affluent demographics, they're not going to be hurt as much, and they're going to be able to afford to pay more, whether it's houses or rent.
Wage inflation's not an issue in the top 20% of income earners. Interestingly enough, I was having a conversation yesterday to a mortgage broker in our business, and she was saying, we were just commenting on how tight borrowing capacity is, but she was saying, look, some of the clients that I've been working on 2 years ago, over the last 2 years, their income has increased by 50 grand or something like that. They might have gone from 200 to 250 or 350 to 4 or whatever it might have been. They tend to be higher income earners. But that's the point, I guess. When we look at wage inflation, it's at a macroeconomic level across all Australians, at 17 odd million working Australians or whatever it is.
Yeah.
That data doesn't really tell us anything. If we look at the top 20%, actually they've got the propensity to increase income substantially more for a longer period of time than the average Australian. And that really helps drive affordability, which obviously helps drive prices in sought after areas.
Sure. So one last mistake that you've been seeing clients make that people should avoid?
So be very careful to make sure that it doesn't feel like we're tooting our own horns here, Michael, but not getting advice is the fifth mistake, and probably the most important one, because getting advice will help you avoid all the other four mistakes as well. But going and buying, and it's very easy today to go and listen to a whole bunch of podcasts and then think, I've got enough knowledge. Mm-hmm. The devil's in the detail. You only have to be a little bit wrong, in my view, to be way off in terms of buying the wrong asset. You can tick all the boxes and there's just one impairment with a particular asset, and that will have maybe a 1% growth differential. And we know a 1% growth differential over 30 years is 30% of the equity, right? So you don't have to be a little bit off. You don't have to be a lot wrong to get it wrong. You've only got to be a little bit wrong to get it majorly wrong, right? So if I'm going to go and invest 500, 600, 800,000, $1 million, $1.5 million, whatever it is, it's a lot of money in an asset. How on earth do I think that I'm going to do a good job if I've listened to a couple of podcasts and bought and sold a couple of properties in my lifetime, compared to someone that's been in the market 5 or 6 days a week for 10 years, that have bought probably thousands of properties over that time? They're going to have a hell of a lot more experience, and nothing's guaranteed. There's always risks, and with investing, it doesn't always work out, of course. Yeah. But if we're thinking about how do I reduce the risk as low as possible, to my mind, it's going and get the advice from someone that that's really good at their job, that you can trust, that has heaps of experience, and listen to that advice.
One of the things they say is you should emulate the habits of the people you're wanting to become like. If it's a sports person, you'd be doing the training that they're doing, the eating that they're doing. If you're wanting to emulate those successful investors, they're all prepared to pay for advice, while the average Australian gets their advice for free over the internet. And we know the most expensive advice is the free advice that's wrong. So I know you say we're tooting our horns, and yes, you give advice at Pro Solution Private Clients, we do at Metropole, and we get paid for it, but the results show. So I think what we've been showing today is that you have got a very holistic and evidence-based view. So if people were to see you at Pro Solution Private Clients, what is your area of expertise? What do you do to help your clients?
I'll get to that in a second, Michael. Just to add, one last comment to the paying for advice. I think it's important to point out that at Pro Solution, we don't buy property for clients. We're not buyers agents, right? So whether my clients, from a completely selfish perspective, whether my clients go and engage a reputable buyer's agent or not, doesn't really change my life. It doesn't make any difference. So for me to come here and say, you absolutely must pay for advice, and I have done that on many, many occasions. I wouldn't buy a property in location without speaking to a buyer's agent. So I eat my own cooking from that perspective. But I wouldn't come here and say that if I didn't absolutely believe that's the best way to reduce your risk substantially. So I just wanted to point that out, that we're not both buyer's agents saying go and get a buyer's agent.
No, you're not.
I'm completely independent from that perspective. So in regards to your question, at Pro Solution, it's really about inspiring our clients to adopt a holistic approach to building wealth. And so if we think about property investing, we need to think about things like tax planning, estate planning, asset protection, mortgages, funding, loan structure, retirement strategy, how it all fits into a longer term plan. There's so many facets to consider and bring it all together. And really, our goal is to bring that team together for the client in-house, where we can all talk to each other and workshop those ideas and deliver a great outcome.
I think that's great. And so therefore, I'll be leaving a link to your Pro Solutions Private Clients website in the show notes, but I'd also encourage people to subscribe to your newsletter there and listen to your podcast. Now, I know we speak about some of the things that are in your newsletter and in your podcasts here anyway, but I enjoy doing it because I guess there's another perspective when the two of us talk about it. But wherever you listen to this podcast, you can listen to the Investopoly podcast as well. So just go look for it. And we'll be back again in a month's time to have another chat, Stuart. Thanks for your time.
That's been really fun. Thanks, Michael.
In a moment, I'm going to share with you my popular mindset message, but I'd just like to clarify a couple of things that Stuart and I were talking about, because I know there's going to be some people who've listened to that and say, they're just feathering their own nest, they're just tooting their own horn. They both sell advice, and on that basis, they're just trying to drum up business. No, we genuinely believe that it's important to get advice, even in the best of times, but particularly in today's current, let's call them interesting markets. And as I said when my chat with Stuart, a fundamental difference between the successful investors I've seen over the years and the average investor is successful investors are prepared to pay for advice. They see it as an investment in their future with a very, very strong return. Now, we at Metropole put together a plan before we even speak about which area and what buyer's agent you should use. And there's lots of different ways of getting to your end destination. So what we've got to work out is, are you in a hurry? Do you want to stop off and have babies along the way, or take a slower journey? What's your risk profile? What are your opportunities? So we put a plan together. We help you plan to become the person you plan to become, and then we implement that plan. Now, is it the right time? I don't know. I don't know your circumstances, but if you go to metropole.com.au and leave us your details, let's have a complimentary clarity consultation and have a chat about it. Because for some people, the current circumstances are creating a window of opportunity, because the low consumer confidence at a time when many of the other fundamentals are strong is what's creating this opportunity. Not because property values have gone down a bit. I'm not trying to time the market. I believe early next year, many prospective buyers are going to realise that interest rates are near their peak, and inflation will have peaked because of the Reserve Bank's efforts to bring it under control. In fact, it's already looking like a lot of buyers are just accepting the fact that, hey, there's going to be another 2 interest rate rises. I'm going to cope with that. Inflation is going to come under control at the end of the year. I'm going to cope with that. And they're getting back into the market. There's a number of the smart economic commentators suggesting that this market's going to turn around early next year. And again, that's why there's currently a window of opportunity to get in before others do. So if you look at the fundamentals, our economy is doing well. Unemployment is very low. So anyone who wants a job's got a job. We've got huge number of immigrants coming to the country, skilled immigrants, as well as students that are going to require accommodation. We're just not building enough of it at the moment. All the new accommodation we're going to build is going to become much more expensive. So there's lots of strong fundamentals, but the cloud is covering up the sun, the cloud of low consumer confidence. When that cloud disappears, as more and more Australians recognise that we've passed through that stage of the cycle and now we're moving to the next stage of the property cycle, the market's going to move on. So I don't want you to miss out on the opportunity that the current market is offering. Now, I don't know whether it's right for you or not, but I believe it's important to recognise that there is a window of opportunity for those with a long-term focus, because there's less competition, there's more time to research, choose the right property, complete your due diligence, and we're in a buyer's market. You've got the upper hand in negotiation. But you can't just go buy any property. That's why we were talking about doing the right research and having the right team behind you. In my mind, less than 4% of properties are currently what I'd call investment-grade properties. But our team at Metropole are in the market every day, watching buyer sentiment, watching how sales are going, looking for other signals that can pinpoint what's really going on. And our research department has spent hours analysing the data. So we've got the art and the science. Go to metropole.com.au. I'll leave a link in the show notes and organise a time for a complimentary clarity consultation with one of our property strategists. You'll be ashamed to miss this window of opportunity.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you a letter written by the late George Bush, the 41st President of the United States. When he died in 2018, a letter of advice he'd written to young people did the rounds of the internet. Now, you don't have to be a young person to appreciate this advice. In fact, I think it's excellent advice for all of us, especially at this time of the year. The letter said as follows: I can't single out the one greatest challenge in my life. George Bush went on to say, I've had a lot of challenges, and my advice to young people might be as follows. Don't get down when life takes a bad turn. Out of adversity comes challenge and often success. He went on to say, don't blame others for your setbacks. When things go well, always give credit to others. Don't talk all the time, said George Bush. Listen to your friends and mentors and learn from them. Don't brag about yourself, said George Bush. Let others point out your virtues and your strong points. Give somebody else a hand. When a friend's hurting, show that friend you care. Nobody likes overbearing big shots. As you succeed, be kind to people. Thank those who helped you along the way. And don't be afraid to shed a tear when your heart's broken because a friend is hurting. Say your prayers. And that was signed by George Bush. Well, there are some words from an elder statesman. I hope you found them inspiring. I hope you enjoyed my chat with Stuart Wemyss today, and if you did and you got some benefit from it, why not tell somebody else about the Michael Yardney podcast? Help me in my quest to make more people financially literate. You can tell them in the old-fashioned way, just tell them about the podcast. There's a share button on every podcast app, or why not tell the world by leaving a review? And if you do leave a review and I read it out as I'm about to for a 5-star review I got on Apple Podcasts just recently, just email me if I read out your review, michael@metropole.com.au, and I'd love to give you one of my books as a way of saying thank you. Now, there's somebody with a very unusual name that I'm not sure how to pronounce, but Hukuyu, which I don't think is their real name, but it's what they actually put on Apple Podcasts, said, great quality content and information. Michael's podcasts are professionally put together and contain great insights into what's happening in the property market. I love the variety of guests and the regular weekly updates. Mindful messages at the end provide a refreshing look on wider topics around property and wealth. So thank you for that fantastic review. I'll be back again real soon, twice a week, but in the meantime, you can catch me on social media. Just look for Michael Yardney. Join me on LinkedIn, Facebook, Twitter, Instagram, wherever you like looking at social media. But more importantly, join my private Facebook group. Go to Facebook and look for the Property Update Facebook group, because I leave some special information there I don't leave elsewhere. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?